Hello guys and welcome again to my channel. So we have here the statement of cash flows or the cash flow statement that I have developed for the past episode. So that concludes the step 6 of the accounting cycle. Now, actually guys, if you're new to my channel, let me tell you that we have had some lectures in the past pertaining to the accounting cycle for service entities. Okay? And we are now on step 6. Now, if you wanted to know more about this comprehensive problem and the step 1 to 6 that we have finished in the past, you can click on the description below. So there is, what do we call this? A link for the complete playlist. It is entitled From Zero to Accounting Hero. So you can enjoy, you can see the complicated, the complex, the comprehensive, not the complex, not complicated, the comprehensive problem from episode 1. And then you'll be able to understand what we went through until now. Okay? So let me also tell you that English is not my first language. So it would help if ever you are going to, what you call this, turn on the subtitles, because I guess the YouTube can capture my words well, even if I pronounce it wrong. And then, if ever you think that my speaking is slow, you can select on the settings of your YouTube application times 1.25 times 1.5 and etc. Okay? So it's up to you. Okay? Now, let's have step 7. Step 7 is actually adjusting entries or adjustments are journalized and posted. So there are two actions in there. Adjustments are journalized and posted. Journalized and posted. Okay? Now, as you can see in this particular whiteboard, I have written already the adjustments that we are very much familiar with because this has been the main topic in the past episodes. Okay, so aside from the journal entries, we have this adjusting journal entries. And because we have this already, as well as in the past episodes, we have this already, then step 7 is already accomplished 50%. So the other 50% is just the posting. Okay? So the posting is actually, what does it mean? It means that on the ledger, which we have here, it's only in the informal version of the ledger, the T account. So I have written the T accounts here. You have to post these adjusting entries to the ledger. And then, if you can do that, then you'll be able to finish already step 7. So let's do that, okay? So we have rent expense. Do we have rent expense right here? Where's the rent expense? Here's the rent expense. We have 6,000. So we have posted this. And then we have prepaid rent, 6,000. Okay? So let's just post this. And as you can see, there are no other entries related to rent expense and prepaid rent. So we can already summarize. So we have here rent expense, 6,000. That is what we call as the adjusted balance. The others are the unadjusted balances still. Okay? Now, as to the prepaid rent, we can also summarize this already. And we will have 15,000 minus 6,000, we have 9,000. So that is what we call as adjusted balance also. So we're already through with the adjustment number 1. Now adjustment number 2. So supplies expense. So do we have supplies expense? We have it here. So we have 16,500. And then we have supplies. So supplies here we have to deduct 16,500. And since there are no other entries pertaining to supplies and supplies expense, we can already summarize that the balance for supplies expense is 16,500. That's the adjusted balance. And of course, in your supplies account, this will have 20,000 minus 16,500. So that's 35. So that's still on debit. So that's the adjusted balance. Okay? So that's number 2. How about number 3? we have depreciation expense and accumulated depreciation. So I have prepared already a T account. So I prepared this already so that I can economize the space. So I did not impromptu made this. I prepared this for you so that everything will be on the board. Okay? So we have depreciation expense, 983.33. And since there are no other entries related to depreciation expense, you can already summarize this as the adjusted balance, so 983.33. And we have the accumulated depreciation to the credit side. So, do we have accumulated depreciation right here? No, we, we didn't. I didn't prepare it. So, let's prepare it. Okay? So, let's put the accumulated depreciation right here. Let's erase this. Let's erase this. Let's put it right there. And we have the accumulated depreciation. Okay. And the accumulated depreciation is 983.33. And since there are no other entries related to accumulated depreciation, then you can put that here, that 983.33 is the adjustment balance. Okay? So we're already through with this one. And we have salaries expense. So salaries expense is right here. So we have 3,000. And then we have salaries payable on the credit counterpart. So since there are no entries related to salaries, we can summarize this as 3,000 adjusted balance, credit for the salaries payable, and 3,000 for salaries expense as the adjusted balance. Now, we're already through with number 4. Let's go to number 5. So number 5 talks about debiting accounts receivable here. So we have our accounts receivable here. So that's 5,000. And then we have service revenues, 5,000. But then again, since there is only one adjustment related to accounts receivable, let's total this immediately. So this is the adjusted balance. And the counterpart is on the service revenues. So we have 40,000. So we have to add another 5,000. And we have 45,000 as the adjusted balance. And we have the unearned revenue. The unearned revenue is to be debited. Do we have an account, unearned revenue? Yes, we have. So that's 80,000 right here. So we have to debit 16,000. That means we have to deduct 16,000 from it. So 80,000 minus 16, 64. I guess it's 64. So that's 64,000. That would be the adjusted balance. Okay? Now, after the unearned revenue, we have to credit service revenue of 16,000. So, I'm wrong with number 5. I thought that the only entry for service revenues on the adjustments is in number 5. There is actually number 6. Okay, so this is not yet the adjusted balance. We have to add 16,000. And how do we add that? That's 21,000, I guess. That's 5,000 plus 16, that's 21. Plus 40, we have 71,000. And this is the adjusted balance. Okay? So, it's as easy as that. So, if you are already masters of adjustments and adjusting journal entries, of course, you will have this already. And if you have this, you just have to post that on the T account or the ledgers. Okay, so what will happen? First, the other accounts will be adjusted. Those accounts that are here will be adjusted. But as you notice, there are some other accounts that were not adjusted. Okay, like for example, this cash, it was not changed. Okay, so this 117,950 cash is both the unadjusted balance and the adjusted balance. Together with, we have office equipment, which has not changed, and then the regulatory expenses. Those accounts, the balances of those are both the unadjusted balance and the adjusted balances. Okay? So that's it for step 7. What about step 8? So, what is step 8? Step 8 is actually closing entries are journalized and posted. So, meaning, we're not just talking about journal entries that are regular or general journal entries. We're not just only talk, we are not only talking about adjusting journal entries. We are also going to talk about the closing entries. Okay? Now, let's talk about first the objective of the closing entries. The objective of the closing entries is to reduce the expenses and the revenues or the temporary accounts or the nominal accounts. So those are, again, the income and expense accounts are considered as nominal accounts or temporary accounts. So we are going to close those temporary accounts. It is because this account should be zeroed out. That is why they are called temporary accounts, because they should be zeroed out at the end of the period or at the end of the year. Okay? Meaning, at the end of the year or at the end of the period, they will be zeroed out in order to start for another expense balances and revenue balances on the next year. Do you follow? And the process of zeroing out the revenue and expenses is what do we call as closing. Okay? So how do we close this amounts, the revenues and the expenses? So we have here service revenues and a lot of expenses. What we're gonna do is to make closing entries. Okay? Closing entries. So, how do we make closing entries? So, the first one that you should do under the step 8, but before we go to step 8, this adjusted balances right here and those unadjusted as well as adjusted balances like this cash, this is the unadjusted balance as well as the adjusted balance. So, this updated balances are considered as adjusted balances and should coincide with your balances in the adjusted trial balance in your worksheet. So we have our video on the worksheet. You can get the amounts right there and compare it to these updated balances if they fit or if they match. Because that is the goal of this adjusting journal entries are journalized and posted. Okay? So, let's go to step 8, closing entries. So, the closing entries are journal entries designed to zero out the expenses and the revenues. Actually, let's do that on the next episode. Okay? So, I have to erase this first because it's a bit difficult to erase. So, let's just make this video as introductory for step 8, closing entries. And again, the motive or the objective for closing entries is to zero out the expense or revenue accounts known as nominal accounts and known as also temporary accounts, so that we can start another set of expenses and revenues on the next period. So that's it for this video. See you on my next one.